Good morning. It's Wednesday. I'm Wayne. Welcome to Wednesdays with Wayne. The first thing I want to do before we get started is thank you for your time, as always. And you'll always have my commitment. I'll do my best to make sure your time is well spent. So thank you for showing up. We've been talking about the difference between an investor and a speculator. The difference is an investor knows their numbers. We've also been talking about making this mental transition from the industrial age where we exchange labor for money into the information or digital age where we exchange ideas for money. So we make money with your mind, not your body. The thing is, you need an education. So the industrial education will not help us in the digital age. We need a digital or informational education. So to me, we've also been talking about how you can get extraordinary returns with minimal risk. Most people are of the mindset that if you want to get a huge reward, you got to take a huge risk, that the two are proportional. I'm here to tell you that's an absolute, total, complete fabrication. They have no idea what they're talking about. You can get extraordinary returns with minimal risk. People do it every day. And the way they do it is because they have a financial education. Unfortunately, our school system didn't teach us these things. They didn't teach us about business. They don't teach us about finance because the product of the public education system is employee, people who would be good, do as they told, make good grades, get a good job, work hard, give your money to someone else, the bank or financial advisor, to tell you what to do with it, and have you stay in struggle for perpetuity. In the real world, to me, you need three types of education. You need a you need a technical education to understand the business you're in, a business education in order to start it, run it, systematize it, and sell it. And you need a financial education. You need a legal education. You need negotiations education. You need some people skills. There's a lot of things we need to learn that the school system doesn't teach us, especially when it comes to people skills. I mean, look what we were taught. Study by yourself, take tests on your own, and don't cooperate. That's called cheating. So it's a whole new world when you become an adult. And when you're a child, you were told what to learn, and you were told when you learned it. Once you become an adult, you get to choose what you need to learn, and you can figure out what you need to know and go learn it. And one way to do that is to increase your leverage or your financial situation is to get a financial education. And so we've been talking about return on investment. A lot of people go, ROI. Well, my ROI is blah, blah, blah. Well, what kind of ROI? Which ROI? There are several types of ROI. So my experience over the years is confusion is the enemy of progress. It's the enemy of marketing. It's the enemy of business. It's the enemy of progress. It's a barrier to progress. And so I'm going to do my best to remove the confusion around this topic called ROI. What are the different types? What are the definitions? What does it mean? How do we measure it? And how do we use it? So a couple weeks ago, we went over cash on cash return. So watch that video if you want to know more about it. If you have any questions, you can always email me, info@buildmyrebusiness.com. And I'm happy to take your questions and happy to respond to them. Last week, we went over this cash flow model, or T-bar. There are 5 things that go into doing these calculations. There's time, which is N. There's the present value or the initial investment, payments either out or into the project during the holding period, the future value, and the return, the yield, or the interest paid. So today, I want to go into this internal rate of return. Internal rate of return is just another way to measure your ROI. And when I see people or hear people talk about this, have you ever had someone talk to you and you got confused? Well, the reason why you get confused is because they're confused. They infected you. Suddenly, it dawns on me, some of these charlatans out there purporting to be real estate investors. Now, this is the difference between an investor and a speculator. Investors know what this means. Speculators don't know what this means. They can't measure it. So typically, when it's all said and done, there's more said than there is done around investing. So I Google this and I go, okay, well, let's just see what the experts say so I can explain it to you in the proper way. So this is the formula for IRR. That's the formula. Good luck with that. I couldn't figure it out. So here's one definition. The internal rate of return is the discount rate that makes the net present value of all cash flows from a particular project equal to zero. Okay. Another one is the manual calculation of IRR metric involves the following steps. The future value is divided by the present value. The amount is raised to the inverse power of the number of periods. From the resulting figure, 1 is subtracted to compute the IRR. That's clear as mud. Here's another one. How do you calculate IRR quickly? So the rule of thumb is that for double your money scenarios, you take 100%, divide by the number of years, then estimate the IRR as about 75 to 80% of that value. For example, let me give you an example. Estimate? You don't estimate IRR, you calculate it. How do you calculate IRR from NPV? Well, it's simple. Sports fans, you just follow this formula. How do how do you know if an IRR is good? A good IRR can be one that is higher than the initial amount that a company has invested in a project. Likewise, a negative IRR would be considered bad. That would mean that cash flow received from the project was less than the amount initially invested. Cash flow was less than it lost money. That's bad. Really? I got to go online to know that. I already know that. I don't have to ask Mr. G if that's bad or not. Dear Mr. G, is losing money bad? Are we really at that point? Come on. Oh, here's a good one. I love this. What is an IRR of 30 mean? An IRR of 30 means that the rate of return on investment using projected discounted cash flows will equal the initial investment amount when the net present value is zero. I cannot explain this, so whatever. Here's what I'm going to do. I've been in several hundred real estate transactions. I'm not an accountant. I don't have a degree in finance or accounting. In fact, I barely got out of high school. But I have done several hundred real estate deals, and actually do okay at it. So I'm going to do my best to explain what an internal rate of return is to me, how I use it, and what it's for. Okay, so the definition for me, an internal rate of return is the return on the investment for the time it's in the investment. In other words, it's the return on each and every dollar for the time each and every dollar is invested. This is why I say if you save money, you lose it, because you do. One way to increase your income, there's a couple of ways. One is work harder. Well, hard work is a highly overrated activity, so no. The other way is letting your money work for you. I know it's an old tired phrase, it's been said over and over and over, but until you understand and comprehend compound interest, which Einstein called the eighth wonder of the world, you will probably struggle financially. So IRR, there's a difference between cash on cash and IRR. Cash on cash is you take a bucket of money and you acquire an asset. At the end of year one, a bucket comes back out. You compare the ratio between the two buckets. That's your cash on cash return. Money went in, money came out. The ratio between the two is your cash on cash return. IRR, see, the thing about cash on cash, it doesn't measure inputs and outflows over time. It doesn't take into account the time value of money. For example, when you own an investment property over time, let's say you're doing a 5-year hold, there's there are times when there will be no money coming out of it. There'll be times there may never be any money coming out of it. Some of the deals that we do, when we collect equity from investors and couple it with debt to do these deals, there's no cash flow and no dividends. It's a 3 to 5 year hold. And so when you're calculating the internal rate of return, it's the money goes in. When the money comes in to us, the interest clock starts ticking. It ticks until we return that money. So during the period, like I'm a deal sponsor, if I'm sponsoring these deals, there might be time you have to feed these deals. You may have losses, credit losses from tenant. They're contractually obligated to pay you rent. They decide it's a bad idea. They cease paying rent. You lose that rental income. Those are credit losses. Or they vacate, so you have vacancy losses. And they damage the property on the way out the door because they're mad at you because you asked them to pay their rent, which has happened. I evicted this couple once and worked with them for 6 months, and they finally just got mad at me, trying to help you pay your rent. And so on the way out the door, they pulled the water line off the upstairs toilet. So the next day I went over there. Of course, by then it had been running all night long. The bottom ceiling fell in. Anyway, this stuff happens. It's the cost of doing business. But so on that, in that situation, I've got the credit losses, I've got a vacancy, and now I have repairs. So now I'm putting money back into the property. Well, that's money that went in that your IRR will pick up and calculate. When did it go in? When did it come out? And so you've got to understand the time value of money. Well, it's like you got to understand. To me, it's important to understand the time value of money because you know how much goes in when, how much comes out when, and when does it go in? Is it an acquisition or is it periodic injections? When does it come out? Does it come out in terms of cash flow or at sale, at disposition? And what is the timing on it? Because money has value and it has value over time. And if you're going to start investing, the best thing you can do is 2 ways to invest. One is start early, because when you start early, compounding is on your side. Once you crack 50, it's too late to become a tree farmer. But if you don't start till later, then you've got to understand leverage because it's the only way out. So it's either timing or leverage. Now, if you're young and you use both, you're good. But if you're not, then you just got to understand leverage and you got to have a financial education. So here is a scenario, and I'll do my best to explain what I understand about IRR, and hopefully it'll be understandable. Okay, here's the situation. Here's our assumptions. We're acquiring a West Campus multifamily property for $900,000. It's a 5-year hold. Then we're going to sell it. It's pure. There's no cash flow or dividends. Well, I shouldn't say that. That's not true. It's a 5-year hold. We think it's an appreciation play. There'll be some cash flow in there. So it's $900,000, 5-year hold, and we sell. 4% annual inflation, and we think it's going to go up about 15%. So we'll sell it for $1,050,000 in 5 years. Our initial investment is $221,000. Our annual cash flow is $27,000 change, and there's no cash flow or dividends. So when you're setting this up, this is the formula we're going to use. We're going to use time, the initial investment or present value, which are brackets. Money coming in is negative, so accounting terms, we use brackets. Payments will be negative or positive. If they're negative, we got to put brackets around them. It's cash flow coming back out to us, it's positive. Then you'll be making payments. Then there'll be the yield or the interest at the end and the future value. So we know what this is. We're projecting what the rents are going to be. We're projecting what the future value is going to be. We want to calculate for IRR. We know the term. So let's fill this out. This is our project. So Let's use blue. First year, number one, we're going to fill out the form. So the present value is 221.1. So it's 221.1 cash to close in this property. The cash flow is $27,632. So in year one, we're going to receive $27,632. Same for year two, same for year three, same for year four. At 5, we're going to get $27,632 plus our sales price. And our sales price, as we're projecting, so we haven't acquired it, we're doing our assumptions up front. And we think it's going to sell for $1 million. So $1,053,000. So you add those two together, and your future value is going to be $1,086.32. $1,080, $632. Hope you can read that. So this is the future value that we're projecting. So if we know this, and we do, if we know this, and we do, if we know this, and we're projecting, and we know this, we can calculate this. So let's do that. So I've suggested that you get one of these, and as you can see on the top line here, these top 5 numbers correspond with the numbers on this chart. So I like to put everything down in writing, and then I start calculating. So you can see we have N at the top. For 12 payments a year, and I want 1. So we're going to change that to 1 payment per year. This has to match the periods. If we're calculating interest monthly or returns monthly, then 12 a year is fine. If it's annually, it needs to be 1 per year. Hope you can see that. So we'll go to N. We go 5N. That's in there. We don't know IRR. We're going to calculate that. Present value is 221.1. That's a negative number, so we're going to press negative. CFJ, as you can see, it shows up as a negative number. Then we have our rent. So we have 27,632, and that's going to say year one. 27,632 is year 2 rent. Press CFJ again, that says 2 and shows the rent. 27,632 again for year 3. There it says 3. There it shows the rent. 27,632. CFJ year 4. There it is. Now in year 5 we have this event right here. We've got the income, plus we've got the income from the sale. So in year 5 we're going to put this number in, 1086.32. So we simply go 10,000,086.32. And then we want to calculate. So you see at the bottom of CST it says IRR. So we push shift, we tell it what to do, and then we calculate it. There it is, minus 2294. I did something wrong. I hate it when that happens. If you do it properly, you put in negative here, positive here, you're going to get, this is 44.24%. And there goes the lesson of the day out the window. I'm going to do this again. 221. 5N. Present value. Yep. 5N. 21, 1. 27,632. 27,632. 27,632. 27,632 again. And then 10,80,632. 44.24. So there it is. Whoops. 44. I erased it. 44.24. Now, what does this mean? It means that this much went in, and this much and that much came out. So our internal rate of return is 44.24%. What's the average? I don't know if there is one. Typically, anywhere between 18 and 20 is pretty good. So pretty good. But let me ask you this. Do cash flows remain constant? No, because if you're a landlord and you have leases out, then hopefully you have rent bumps in them. So due to the costs going up, we've got to have inflation built into our leases. So we calculate a 4% bump every year, and it recalculates every year. If you are leasing property, then you're probably, especially if it's commercial, you're probably familiar with the triple net lease, which means you have a lower base rent, and then you have these other expenses that you're paying. It's called TIM, the taxes, the insurance, and the maintenance on the property. So they give you a lower base, but your rent's going to be fairly high depending on what. So there's two numbers. There's your base rent, then there's the triple net amount. So your base rent's $15 a foot, your triple net's are $8 a foot, you're $23 a foot. And this is the way that landlords hedge risk or manage risk, is they pass the risk of increased expenses, including taxes and insurance and maintenance, on to the tenants. And so if you're a tenant, you know these. Annually, your rent goes up. You get these bumps, these increases. So if you're a landlord, make sure you have rent bumps in your leases. If you're a tenant, try to get out of it. But it's hard to do. So nonetheless, let's say we have this multifamily project, and this is a fairly simplistic scenario, but to think that rents are going to remain steady for 5 years, I mean, it's interesting to run and see if we can figure out what our projected IR is going to be on this property. But to think it's really going to perform that way is not realistic, because these rents are going to change. This may go down in 1 year because you have vacancies, or like I said, credit losses or repairs. You may have to write a check to put capital infusion to repair it or maintain it, or you may just not have that much rent because it didn't come in. The point is, if this number were the same every month for 60 months, that would be an aberration. It'd actually be a freaking miracle. So let's say that we're going to calculate this again with our rent bumps in it, and hopefully we can get it done right this time. So if I was going to do this, I would do the same thing. We have our present value of 221.1. At acquisition. And then let's say that we have a 4% bump. What happens in year one is our rents are going to be 27,632, just like before. But the next year they're going to go up by 4%. So 27,632, if you take that and you add 4% to it, That's going to be 1105 and change. So our year two cash flow is going to be 28,737. And then you add 4% to that. So you take this number plus 4%, you get this. You take this number plus 4%, you get the next one. This is compounding. So we have the interest, then we have the interest on the interest. This is what compounding is. It's a classic example. So in year three, we've got 28,737 in year two, plus 4%, which is 1149. That's going to increase our rent to 29,887. 887. And then you add 4% to that. So in year four, you take 29,887, add 4% to that, which is almost $1,200. You get 31,082. So in year four, it's 31,082 plus, and this goes on forever, or in this case, 5 years. So then in year five, we have 4% added to this. That's 32,325 plus our disposition of 1053, $1,053,053. So that's a total of 1085,325. 1085,325. So let's get our little friend and see if we can make some sense of this. So if we start over like we do before, we've got 10, 5, 325. Future value, we've got 5 years, 221,100. Negative into the property. I'll clear this. 5N 221,100. Hope this is helpful. So that's year zero is the 221,100. Our first year's cash flow is 27,632. So we enter 27,632, press CFJ, and it calculates. Year two is 28,737. CFJ says year two and calculates it. Year three is 29,887, so we enter that. CFJ says 29,887, so we know it's, so far we're doing this correctly. Year four is 31,082. This is cool. CFJ. And then year five, we've got these two events, right? So we collect our rent, and then we also collect sales proceeds. I know there's costs coming out of that, but hang on just a second. Some people can wear these earbuds fairly easily. I'm not one of those. So 31,082 in year four, and then year five we have 1,085,325. 1085,325. Sorry, get this in where you can see it. And then we want to calculate, not sure what happened there. I hit a button when I was trying to get my earbud back in my ear. We're going to calculate IRR. And yeah, I'm sorry, my fat thumb screwed it up. So I'm going to do this again. 5, Future value is 1085, 325. $21,1. 5 in 1085, 325. Future value 221, 100. 27,632, 28,737. Year 2, 29,887 in rent. Year 3, 31,082. Year 4, 10, 44.66. This is our IRR. So that tells me that that is the percentage of investment, the time this money was in this investment. So as you can see, we didn't put any extra money into it. There were no dividends or cash flows paid out of it. We rolled the rents in. And so that's a pretty decent IRR. The thing is, it doesn't vary a lot. This is 44. It's not a huge difference in terms of IRR from the first one, but look at it like this. If you look at the differences in the rents, then over the period of time, you've added almost $5,000 in rent to the property. So anything you can do to increase rents obviously increases value, but increases exponentially. So let's take, I actually calculated those. It's $4,693. So if you take the 4693, and let's say cap rates in your area are 4%, then you just added $117,000 in value to the property with a 4% a year rent bump. So we'll go into it again next week. We'll go into cap rates, the definition, what they are, what they mean, and how to use them. But right now, if you can understand this T-bar, this cash flow model, and that if you have any 4 of these 5 components, it can always pick up the 5th one. So if you want to know how long it will take you to get this return with these rents and that present value, you just calculate it backwards and plug in 44.66 here. This is your future value. Calculate these as the payments, and that is present value negative. It'll tell you 5 years. If you want to know how much cash you need to hold the property for 5 years and get a 44.66 return, and these are your rents and that's your present value, it'll tell you that. So whichever of the 4 you have, it'll tell you the 5th one. So it does pretty well, I think. That's pretty solid. I think not bad as initial investment. But the thing is, you can use this model and this calculator in this way to measure the value of just about anything. An annuity, a piece of property, your house, anything. And so when people say to me, I say, why don't you invest? I go, I don't have the money. I don't have the money. Really? But you're driving with a $50,000 truck. Why don't you take that money and buy a property? So I got to thinking about it, and I thought, what if we did this on a new vehicle? And so when I talk about time value of money, one of the essential elements of time value of money is opportunity cost, right? We went over this. So when you look at time value of money, the reason it's so important to understand for me is because, number one, a dollar received today is worth more than a dollar in the future because you can start using it right now. You can spend it now, which because you have more purchasing power because there's going to be inflation. Prices are going to go up. So if you have money now, it's worth more now than it's going to be later. Secondly, your risk is less because you can't lose a dollar you have, and unless you go blow it on a bad investment. And the point is you have it. And the third one is opportunity cost. It's when one investment outperforms another one and you chose the other one, not the one that outperformed. And the difference of the delta between the two is your opportunity cost. You just chose the wrong one. No big deal, it happens. But knowing how it happened and why it happened is crucial to making your next decision. So I thought, what if we did a truck? Well, let's say you bought a truck, okay? Let's say this truck had a present value of $50,000. And let's say you got I asked Mr. G what auto rates were in Texas. They said 7 to 12%. So let's say you got great credit, 7% loan, $50,000 truck. I also asked Mr. G what this $50,000 truck would be worth in 5 years. Guess how much value it loses? So the real estate value went up or down? It went up. What happened to the value of this thing? Well, according to Mr. G, they lose 30%. So this thing, 60%. So this thing is now worth $30,000. I'm talking percents and dollars simultaneously. My brain doesn't function. $30,000. So it drops from $50,000 to $30,000 in value. It loses 60%, according to Mr. G. Meanwhile, we're doing what? We're making payments. So let's say we get a zero down deal. Let's say we got 7% interest and our payment's $1,000 a month. So you got $12,000 this year, $12,000 in year 2, $12,000 in year 3, $12,000 year 4, and year 5 it's another $12,000 because you still own it. And then let's say you sold it for 30. So this is crazy. So here it went from 50 to 6. It went from 50,000 to 30,000. So I lost 20,000 there in value. Plus it's the 12, 12, 12, 12, and 12. So what is that? 48,000 plus 48,000 in payments. 68,000. So this is why the biggest problem is in America is people buy these vehicles. So they take money, they usually borrow them because they don't have cash. So when people borrow money they don't have to buy things they don't need to impress people, spending is up. And so the point here, ladies and gentlemen, is I don't have a problem with this, but I want this to pay for it. So your investments pay for your consumption. Your assets should pay for your liabilities. And if people don't understand time value of money and opportunity cost and risk, then this is why they just say, you know what, it's too hard. Rich people are crooks. And they make the rich wrong rather than figure out how they got rich. That's ego. And the biggest obstacle to learning is ego. And I learned long ago because I was at one time extremely egotistical. But one day I woke up, I said, I'm getting my butt kicked, getting my hat handed to me out here. So I decided not to let my ego interrupt my cash flow. So I became a lifelong learner. And this is what I've been studying and using and learning. So I hope this helps. And that's it. This has been Wednesday. This is Wednesday. I'm still Wayne. I appreciate your time. Thank you. I hope this is helpful. You can understand and get yourself an HP 10B. But if you can go through these simple calculations and figure out how much money goes into the investment and when, how much comes out and when, who puts it in, where does it come from, who's taking, how much risk is involved, and who's taking the risk. I'll see you next Wednesday at 9 o'clock. Thank you for your time. I hope you found it well spent. If you have any questions, email me, info@buildmyrebusiness.com, info@buildmyrebusiness.com, the Real Estate Business School, where you get your license and learn to use it. This is the learn to use it part. Hope that helps. Next week, cap rates. Talk to you then. Thanks. Bye. Have a great week.